Imagine a Sunday night in August 1971. You're sitting on your sofa, the hum of the television filling the living room, waiting for the evening news to end so you can get some sleep before the work week begins. Then the programming is interrupted. President Richard Nixon appears on the screen. He isn't shouting. He's calm, authoritative, and almost fatherly. He tells the nation he is temporarily suspending the ability to exchange dollars for gold. It sounds like a dry, technical adjustment, a bit of monetary housekeeping to handle a short-term crisis. Most Americans went to sleep that night believing their savings were exactly what they had been the day before, but they weren't. In those few minutes of airtime, a tether that had held human civilization together for centuries was quietly snipped. What is truly remarkable is how little changed the next morning. People still went to the grocery store, they still cashed their paychecks, and the shops still accepted their paper bills. There are no riots, no panic in the streets. The illusion of value was so perfectly maintained that almost no one noticed the most important thing in their lives. The money they bled for, saved, and traded had just been untethered from physical reality. It had transitioned from a receipt for something tangible into a token of pure faith. We were told it was an emergency measure, a stopgap. Yet, over 50 years later, that gold window remains shut. We are living in the longest temporary experiment in financial history, a world where money exists simply because a government says it does. But history has a very specific, very brutal way of dealing with systems built on nothing but trust. Whether it was the silver coins of a crumbling Rome or the paper kites made of worthless banknotes in Weimar Germany, the pattern is always the same. We like to think we're different, that our digital ledgers and central bank engineers have finally mastered the machine. But once you realize that the anchor was lost decades ago, you have to ask, how much longer can a system stay afloat when its only foundation is the hope that no one looks down? That opening really establishes the profound stakes of this deep dive. Our mission today is to look squarely at the critical question that comes out of that post-1971 world. What happens to a society, and I don't just mean its balance sheets, but its core social fabric, when the foundation of its money shifts from tangible reality to, well, a token of pure political faith?
Exactly.
So we'll be unpacking the deep systemic, societal, and economic consequences of unanchored money. We're going to examine some historical precedents that offer, frankly, some brutal warnings, and then analyze how different global economic powers manage this new, radically flexible reality that we all inhabit.
And this is really a deep dive into institutional trust itself. I mean, the end of dollar-gold convertibility in 1971 was a profound structural and, some would argue, an irreversible change in how value is perceived and managed on a global scale. So we're going to frame our exploration for you across three core areas that really synthesize the source material we've gathered. First, we'll drill down into the immediate, measurable financial data of the decades right after 1971.
The hard numbers.
The hard numbers, and they reveal this mechanical erosion of monetary confidence, and with it, an exponential rise of pure speculation. Then second, we'll analyze the profound sociological and even familial destruction that's caused by losing a predictable, trustworthy monetary measure. We'll use the catastrophe of historical hyperinflation as our clearest lens for that. And finally, we'll look at the long, really complex global history of states attempting to impose some kind of structural discipline on their monetary systems, which gives us some essential context for understanding the current fiat experiment.
Okay, so let's unpack the mechanics of this shift. Before 71, the dollar was constrained. I mean, the U.S. government could print money, sure, but there was this institutional limit, the fact that foreign governments could, in theory, exchange those dollars for a fixed amount of gold.
Right. The anchor.
Exactly, the anchor. So when that gold window closed, the monetary authority essentially got the unlimited power to create currency out of thin air. What was the immediate quantifiable result of just removing that limit?
Well, the data since 1971 offers a really consistent and, to be honest, a pretty grim pattern. The abuse of this new unilateral power.
It's a temptation.
It's a huge temptation. The sources indicate that the money supply started growing at an unprecedented rate, and conservatively, we're talking 3 to 4 times faster than the growth rate of the real, tangible economy itself.
3 to 4 times, wow.
And this isn't surprising if you're an economic historian. When governments get unlimited power over currency, there's always an intense political temptation to use it. You create excessive money to fund popular programs, cover deficits, subsidize special interest groups. And this creation of money, which inevitably leads to inflation, allows certain groups, the ones who get the newly created money first, to profit immensely, while the rest of the innocent citizens, well, they bear the cost through dollar depreciation. This imbalance is structural to the post-71 fiat era.
So when we talk about inflation in this context, we're not just discussing prices going up because, say, demand is high. We're talking about the dollar itself rapidly losing its ability to store value. How starkly did the statistics actually show this depreciation in the years right after 1971?
The statistics are stunning, particularly in that first decade, which was a period of just immediate turbulence as the system adjusted to its new reality. The standard measures of price growth become, in effect, a precise measure of the dollar's loss of value. Let's just look at the period between December 1971 and December 1981, a single decade.
Okay.
The Consumer Price Index, the CPI, which tracks the cost of a fixed basket of goods, it jumped from 123.1 to 281.5. And that's using 1967 as the base year of 100.
That's more than double.
It's a staggering 128.7% increase. And to put that into relatable human terms for you, a 128.7% jump means that if you needed to spend 1 hour of your labor to buy a specific necessity in 1971, you would need nearly 2.5 hours of your labor to purchase that exact same item just 10 years later.
So your savings were just eviscerated.
Cut by more than half in terms of purchasing power in a decade. And the depreciation was also clearly visible at the production level. The Producer Price Index, the PPI, saw an even bigger spike. It went from 115.4 to 275.3. That's a 138.6% increase.
Wow.
And if we look at the implicit price deflator for GNP, which is a broader measure of price change across the whole economy, it nearly doubled. It rose from 96.01 in 71 to 193.57 in 81. The retail prices of goods, by the government's own best statistics, more than doubled in that one decade.
So a dollar bill in your pocket in 1971.
You'd need about 2.5 of those by 1981 to equal the same real-world purchasing power. That is the very definition of profound currency depreciation, and it happened almost immediately after the anchor was cut.
And that rapid structural loss of confidence has to immediately filter into the financial system, right? Specifically, the cost of long-term planning, the cost of debt. When the dollar's future value is dependent entirely on the political whims of Washington and the Fed, what happens to the market's willingness to lend money?
It absolutely obliterates long-term confidence. The most painful manifestation of this collapse of trust is what you see in interest rates. In the decade after 1971, interest rates had just soared to heights never before seen in American history. They exceeded even the peaks of the Civil War's greenback era.
And what kind of numbers are we talking about?
The prime rate, that's the rate banks charge their most creditworthy customers. It soared to over 21%.
21%.
Yeah. And the source material argues quite forcefully that unless a redeemable anchor is restored, higher and more volatile interest rates are just. They're structurally bound to happen.
Now, we often hear that high interest rates are used to fight inflation, but the source material seems to argue that high rates are actually a symptom of the currency problem itself, not the cause of inflation. Can you elaborate on that distinction for us?
That is the core insight here, really. While it's true that central banks use interest rate hikes to try and slow the money supply, the principal cause of the wildly fluctuating high rates since 71 is something called the inflation premium.
Okay, what's that?
This premium is simply the extra amount that lenders have to charge because they anticipate a further depreciation of the dollar over the term of the loan. Think about it. If a bank lends you $100 today, and they expect that by the time you pay them back, that $100 will only buy $80 worth of goods, they have to charge enough interest to recover that lost purchasing power, plus a real return on top.
So it's basically a trust tax.
That's a great way to put it.
Yeah.
High interest rates are fundamentally a result of currency depreciation and are inversely proportional to the level of trust people have in the money and the government managing it. They are a market-based measure of official incompetence, or you could argue deliberate debasement.
Right.
When a currency is trusted and redeemable, there's no need for this massive, unpredictable inflation premium, and stable low rates are the norm. The instability in interest rates is just the market reacting to an unsound and politically managed currency.
Let's connect this back to the real economy. For a business owner trying to, build something, hire people, borrowing capital at rates over 20% must be absolutely crippling. What was the fallout of this volatile debt environment for business and personal stability?
It created an almost impossible operating landscape for productive enterprise. I mean, trying to maintain a viable, profitable business model when your cost of capital is 21% is structurally infeasible.
You can't make it work.
You can't.
Yeah.
And this crippling debt environment led directly to a massive structural increase in financial failure. If you look at the raw numbers for that single decade, total business and personal failures just exploded. They rose from about 201,000 in 1971 to over 519,000 in 1981.
That is a staggering increase.
It is. And that rapid acceleration in financial stress, unmanageable debt, and ultimately bankruptcy is a direct cascade effect of the currency's instability.
This leads us to a fascinating question about where capital actually goes when productive borrowing becomes impossible. I mean, if the traditional path of taking out a loan to build a factory or hire more workers becomes too expensive or too risky because of currency volatility, the capital that's being created has to find another outlet, right?
Exactly. The lack of a stable, sound currency, a predictable unit of account, it actively discourages long-term productive investment. And instead, it encourages massive short-term speculation. The capital doesn't just disappear, it migrates to where the rewards are greatest. And post-1971, the greatest rewards were in the financialization of money itself. Just consider the explosion of new markets. 10 years before 1982, most of the sophisticated futures and options markets that define finance today, they just didn't exist.
So why did they suddenly emerge?
Because when the currency is unsound, trading in the currency, betting on government monetary inflation, and speculating on derivatives becomes immensely more rewarding than the conventional risky business of brokering loans for production or building tangible goods. All the ingenuity shifts from, say, engineering to financial engineering.
Can you give us a concrete example of how this speculative frenzy overtook real production?
The scale of speculative growth is immense, and it's sometimes absurd when you compare it to real-world production. You saw the creation of futures and options sold on stock indexes, large certificates of deposit, basically betting on the direction of markets, not necessarily investing in them.
Right.
And a particularly illustrative anecdote is that in 1980, the trading volume for U.S. Treasury bond futures contracts on the Chicago Board of Trade dramatically outpaced the trading volume for contracts in cattle.
Wait, say that again? More betting on government debt than on cattle.
Far more. Think about that for a moment. The market for betting on the daily short-term value of government debt and long-term interest rate movements became a larger enterprise than the market for one of the most fundamental, tangible agricultural products that feeds the nation.
That's incredible.
This phenomenon has been called the apotheosis of financial capitalism, where the vast bulk of global money transfers are dedicated solely to exchanging money for money in another form. It largely abandons the traditional political management of currencies and trade in favor of this massive, autonomous global circuit of capital. And the sources contend this frenzy will continue and likely accelerate as long as the underlying currency remains unsound.
The financial numbers show that immediate strain, but the true cost of losing sound money is the systemic corrosion of the essential social and civic structures underneath the economy. It's when everyday life itself transforms into a source of panic, and planning becomes impossible. To understand the depth of this social decay, we have to turn to the historical example of Weimar Germany, which is just a catastrophic warning.
It really is. Weimar Germany's hyperinflation is the quintessential case study of the destruction caused when the state completely loses control over the money supply. The price increases weren't gradual, they were exponential and ultimately incomprehensible.
What kind of numbers are we talking about here?
Well, from 1914 to the end of World War I, prices increased by a relatively small 140%. But in 1922, they increased by 5,470%. Then, the system just completely seized up in 1923, resulting in a staggering price increase of 75 billion%. 75 billion times the original price.
I can't even get my head around a number like that. How does a society function when money loses meaning that quickly? What happens to the basic function of economic calculation?
It leads directly to what's called economic calculation failure, which destroys the entire productive system. Economic life fundamentally relies on money prices as the basis for profit and loss accounting. If a firm pays its workers today, it expects to sell its product tomorrow at a predictable margin. When prices increase hour by hour, firms and individuals cannot calculate profitability. The raw material you bought this morning is suddenly worth far more than the product you use it to create, and then an hour later it's the other way around.
Just chaos.
Utter chaos. This systemic failure resulted in widespread delirium and this desperate flight from the depreciating mark. We have historical anecdotes describing factory workers being paid their wages at noon every day, and they would immediately run out with baskets or sacks full of banknotes.
Yeah.
And the goal wasn't to buy what they needed, but to buy anything tangible cuckoo clocks, antique furniture, ill-fitting shoes, just to store value in a physical object rather than holding the state currency.
Wow.
The sources cite one contemporary who described the insanity of numbers in 1923 Berlin as just pounding daily on the nerves.
So currency stability is essentially a tool for predicting the future cost of goods. When that tool is broken, the ability to plan beyond the immediate moment just vanishes.
Precisely. The only thing people believed about the future was that money prices would continue to rise, and this led to a collapse of the transactional economy. People began actively rejecting the mark and resorting to complex, localized barter systems because the currency had lost its fundamental purpose as a stable medium of exchange and a reliable unit of account. Production became erratic, and capital just vanished.
When that radical uncertainty about the future takes hold, the long-term, capital-intensive projects that are necessary for societal continuity, things like raising children, saving for retirement, or forming a lasting marriage, they must be attacked at their very foundation. This feels like the core sociological consequence.
This is the critical insight that's often overlooked when we focus only on the economic metrics. A stable and predictable monetary framework is, in fact, the essential foundation for preserving the core family unit and meritocratic social structures. Inflation is profoundly corrosive because it forces people into an intensely present-oriented survival mode. You have to consume immediately because holding wealth for the future is punished.
Right, saving becomes irrational.
It becomes irrational. And rearing children is perhaps the longest and most capital-intensive project any individual undertakes. It requires saving and deferred gratification investing today for future food, education, security. The economist Joseph Schumpeter recognized this when he questioned the incentives for potential parents to, in his words, stunt our ambitions and impoverish our lives by having children when money loses its future value. Under stable conditions, parents can reliably devote capital for their children because money's purchasing power is constant. Under hyperinflation, that ability vanishes, and having children becomes a profound, immediate financial burden that you just can't plan for.
And did we see this reflected in the actual demographics of Weimar Germany during the crisis?
Absolutely. The data is crystal clear. The German birth rate peaked at 25.9% in 1920, right after the war. But as inflation became a daily catastrophe, the birth rate rapidly declined. It fell to 25.3% in 21, then to 23% in 22, and it hit a crisis low of 21.1% by 1923, the absolute peak of the hyperinflation.
That's a huge drop in just a few years.
A massive drop. The sources emphasize that for the poor and unskilled, often reliant on relatively fixed wages or welfare payments, the crisis was catastrophic and the calculus changed immediately. The more children, the more difficult life became. Inflation acted as a profound, if indirect factor, leading to a demographic collapse in a planning-oriented society.
And what about marriage itself? I mean, forming a marriage and sustaining a family unit relies on signaling intent, trustworthiness, credibility through rituals and planning things that cost time and money.
The crisis undermined the very rituals of commitment. Dating, engagement, all the customs around marriage formation require time and money. They act as signals that potential spouses and their families can use to gauge long-term reliability.
Right.
When inflationary conditions prevail, the cost of engaging in that entire marriage formation process just spirals out of control. And furthermore, inflation raises the marginal costs of simply being married. It increases internal tensions and financial strain on the partnership. And empirically, during the Weimar crisis, marriage rates declined significantly while divorces increased. The collapse of the money supply fundamentally destabilized the core institution of the family unit, leading to widespread separation and decline.
So currency stability is the prerequisite for social stability. This immediately makes me think of the powerful sociological concept from Polanyi, the idea that the economy is embedded in society, not separate from it. Specifically, his discussion of fictitious commodities.
That is the perfect lens through which to view the social breakdown of Weimar. Polanyi's central argument, which he developed in his seminal work, distinguished sharply between localized markets, which have always existed, and the full-blown, self-regulating market system. And he famously identified three elements of production, land, labor, and money as fictitious commodities.
Why fictitious? What does he mean by that?
They're fictitious because they aren't genuinely produced for sale in a marketplace like a manufactured good. Take labor. It is intrinsically embedded in human beings, carrying with it their sociality, their hunger, their anger, their need for dignity. It resists being treated purely as an input cost.
Right. People aren't widgets.
Exactly. Land, too, is embedded in location and ecology. It can degrade, flood, or refuse to yield. And money, as we've been discussing, is never fully instrumentalized. It is a symbol of trust and governance. Polanyi argued that the great societal problem arises when the expansion of the market tries to treat these three elements as if they were unbound, genuine commodities, subject only to the ruthless logic of supply and demand. He believed these elements require institutional anchoring to the moral and political fabric of society. And when the self-regulating market is allowed to treat land, labor, and money as mere inputs, it leads inevitably to social enemy, the profound breakdown of norms, social cohesion, and predictable expectations.
Which is exactly what we saw in Weimar.
The social chaos of Weimar Germany was the ultimate example of this enemy, driven by the commodification and destruction of money's stable meaning. The historical struggle, Polanyi argued, is society's necessary resistance to protect these fictitious commodities from the disembedded market.
So if the 1971 U.S. decision represented this radical shift toward a system lacking inherent, tangible anchors, we really need to broaden our view globally. What does historical precedent, especially in non-Western systems, tell us about how successful states maintain monetary discipline and stability? Does stability always require a gold anchor?
Well, history suggests that control over the currency is intimately linked to state power and stability, and that structural discipline can be achieved through mechanisms other than just direct convertibility. A really powerful example is the historical evolution of Chinese monetary policy.
Right.
The sources emphasize that from the Yuan dynasty onwards and continuing right into its modern structure, China has demonstrated this long-term commitment to maintaining social order and financial stability through state-led innovation and sophisticated structural discipline.
So it's a different model of management.
A very different model. China's approach is defined by a managed system where the expansion of the market principle is significantly modified by redistribution, undertaken both by the state apparatus and by localized kin and neighborhood structures. The state consciously provides structure to manage economic processes and restrains the market's ultimate reach, preventing that Polanyi-esque social enemy we were just talking about. For instance, even with land, a major fictitious commodity, the market principle is fundamentally limited. Land is seldom farmed by anyone other than the designated holder of the use rights. This demonstrates a profound, state-enforced structural discipline that prevents the total commodification of that primary factor of production. This dedication to managed stability is a strong counterpoint to the extreme volatility inherent in purely disembedded market systems like the U.S. post-1971.
That offers a deep structural case study. Let's look at the sweep of history through the eyes of the anthropologist David Graeber. His work gives us a fascinating chronology of how money's form has oscillated over millennia, often linked to coercion and violence, not just trade.
Graeber's analysis is fascinating. He organizes monetary history into 4 distinct long-term ages, each defined by the dominant form of currency and the social structure around it.
What's the first one?
First is the age of agrarian empires, from about 3500 BCE to 800 BCE. This period was dominated by virtual credit money. Debts were calculated in abstract units, often silver, but were commonly paid in barley or other acceptable goods. This relied heavily on administrative record-keeping in large public institutions like temples and palaces. Money here was primarily a unit of account for managing state debts and obligations.
So basically a giant ledger system?
Exactly. Then comes the Axial Age, from 800 BCE to 600 CE. This period saw the decisive introduction of coinage and metal bullion. And this shift, according to this historical viewpoint, was profoundly linked to state violence and warfare. Coinage seems to have been invented primarily to pay soldiers reliably across great distances.
Okay.
The use of standardized metal coins facilitated large-scale military logistics and enabled the creation of truly impersonal markets because the money was now guaranteed by the coercive power of the state that minted it.
That transition feels like a major shift, moving money from administrative credit based on centralized records to a physical, tangible token that's backed by military force.
It was a monumental shift. And following this came the medieval period after 600 CE. Here, money became largely delinked from coercive institutions. This de-emphasis on military-backed coinage led to a flourishing of economic institutions premised on social trust and decentralized credit. You can see this particularly in expansive networks like the Indian Ocean trade. This period saw major innovations. China invented paper money. Complex credit systems developed globally, showing that highly sophisticated economic organization doesn't strictly require a bullion anchor, but rather a different form of institutional trust.
And that brings us to the modern era.
It does. Finally, we reach the age of European empires from about 1500 to 1971. This was characterized by a massive return to precious metals. This relinked money directly with coercive states, primarily through deficit financing used to pay for increasingly expensive global wars. The sources argue that during this time, the ideological return to metallism, the belief that money must be physically backed by metal, became dominant, often masking the underlying reality that states were continually inflating and creating debt to finance their military objectives. The 1971 severing of the gold link essentially ended this particular age.
The American experience is certainly an intense example of that constant struggle within that final age, the internal tension between those who favored hard, stable money and those who pushed for inflation.
Absolutely. The history of the U.S. dollar is just a chronicle of battles to define and restore convertibility, highlighting that constant political temptation to inflate the currency. In the early American struggles, we saw how quickly colonial paper money, notably in Rhode Island, depreciated when it lacked convertibility, while neighboring Massachusetts, by returning to specie, quickly restored price stability. A prime example of the fight for monetary discipline was the Jacksonian era. Andrew Jackson's administration sought explicitly to sever the federal government from the centralized banking system, a precursor to the modern Fed, and place all finances on a hard money specie basis.
So, pure gold and silver.
Exactly. They successfully fought to establish the independent treasury system, requiring the government to keep its funds purely in gold and silver coins in its own vaults. The goal was a currency composed of honest, predictable specie, and they were so committed they established branch U.S. mints across the South in 1835 just to increase the coining of gold. This was a direct political effort to enforce structural discipline.
But war always seems to override that discipline, doesn't it? The Civil War forced the U.S. off its hard money path.
It did. The exigencies of the Civil War led to the creation of greenbacks, which were irredeemable paper money. And what's particularly instructive here is the government's attempt to enforce value through coercion. When the greenbacks began to depreciate rapidly against gold, the government tried a despotic measure, the gold bill, which prohibited futures contracts in gold, effectively trying to regulate the market by destroying it.
How did that work out?
It was a disaster. The market fell into utter chaos and public confidence plummeted even further, causing the paper dollar's value to drop immediately from 52 cents to 40 cents in gold right after the bill's passage. The fluctuation wasn't in the gold market, it was the paper currency, which was utterly beyond the control of individuals and actively destabilized by political intervention. The government was forced to repeal the bill a mere 17 days later.
Wow. Still, despite that historical turbulence, the U.S. did eventually manage to restore confidence and enter a period of stability based on the gold anchor, which provides a strong counter-narrative to the post-1971 chaos.
It does. That era, the gold standard boom, provides critical evidence of the benefits of a trustworthy unit of account. The successful resumption of specie payments in 1879 inaugurated a decade of profound prosperity and economic growth.
Right.
Now, critics often argue that the gold standard caused deflation, but the sources point out that while prices did fall by about 1% per year, much less than during the greenback era, this was due to massive increases in productivity, not economic depression.
So things got cheaper because we got better at making them.
Precisely. And critically, wages rose during this period. So falling prices combined with rising wages meant a sharp, tangible increase in the living standards for all consumers. The gold standard fostered confidence, encouraged saving, and led to stable, low interest rates. We see evidence like 100-year bonds being sold at only 4 to 5%. That stability fostered long-term planning and investment, providing a direct historical contrast to the volatility we saw a century later once the structural discipline was politically abandoned.
The lesson just keeps emerging from all these historical examples, that the economy isn't some rational, calculating machine operating in a vacuum. It is profoundly and inextricably embedded in society. When that pure calculative market logic expands, as it did so radically after the anchor was lost in 1971, how does society instinctively resist this colonization of everyday life?
The sources really reinforce Polanyi's core thesis. For a society to survive, the market has to be limited by institutional regulation to prevent social decay. This necessity drives what he called the double movement, society's inherent, powerful counter-movements against a self-regulating market. Sociologists describe this tension as the ongoing dialectic between the mutual domain and the market realm.
So if the market realm is defined by competitive trade and pure calculative reason, what are the characteristics of this mutual domain?
The mutual domain is the social fabric itself. It encompasses communal needs, non-market exchange, sociality, and the web of relationships, the essential human element. As the market expands its reach, driven by the logic of profit maximization and efficiency, it invariably colonizes and debases the very mutual domain upon which any stable economy ironically relies. It turns relationships into transactions. Take the concept of thrift, for example. Thrift, the act of saving, economizing, being frugal, is inherently a practice that starts in the communal domain. It's focused on meeting collective needs and standing as a bulwark against indulging in market wants.
Sure.
Yet the market is relentless in trying to recruit this concept. We see this constantly in advertising. A sale is presented not just as a cheaper price, but as an act of thrift. It allows the buyer to see themselves as both a shrewd market participant and a responsible communal member who is economizing for their household. This is how calculative reason infiltrates and co-opts communal practices of saving.
And when this drive for pure calculative efficiency is applied to the very heart of economic organizations like corporations, the social destruction becomes acutely visible.
The movement of corporate downsizing in the 1990s in the United States is a perfect illustration. The stated goal was short-term calculative efficiency and increased shareholder value. However, this focus on immediate efficiency often resulted in the complete destruction of employee loyalty and morale, the mutuality upon which the corporation's actual long-term success depended.
Right.
Downsizing in this light epitomizes the severing of salary, job security, and long-term relationships, fundamentally turning a communal workplace into a purely contractual short-term exchange.
That sounds like a textbook case of sacrificing long-term stability for short-term financial gains. But did the efficiency actually materialize?
Well, the sources cite analysis from economists who looked closely at the effects of downsizing. And they concluded that it did not actually increase corporate competitiveness or long-term productivity, which was the justification given to the public.
So what was the real reason?
Instead, they found that it was overwhelmingly an effective strategy for holding down wages, significantly raising profits, and explicitly transferring income from the labor force to the management class. This transfer of wealth was the dirty little secret of downsizing. It shows how the colonization by the financial realm, driven by pure abstract calculation, actively undermines the social community and embedded relationships that are necessary to sustain the enterprise in the first place.
If the market is always trying to disembed human relations, we have to look closely at money itself. It functions as both an abstract tool for calculation and, at the same time, a deeply personal and social link.
Money is one of the most powerful and complex social tools we have. It is an abstract creation designed to be impersonal, to connect individuals across vast social distances. And yet, human beings invariably reclaim it and make it personal. It serves a crucial function as a memory bank, stabilizing the individual's personal identity by allowing them to hold something durable that embodies the desires and accepted wealth of all other members of society.
A memory bank. I like that. So it's like a time machine for your labor.
That's a great way to think of it. When its value is stable and predictable, saving $100 today means you are effectively preserving the exact purchasing power that represents, say, 10 hours of your labor for a future purpose, a down payment, education, retirement. That stability is the social function that the memory bank provides. When the currency depreciates, that memory bank fails, and the value of your stored labor is erased, undermining your personal identity and ability to plan. Money's profound social power comes from its unique ability to mediate between two extremes. The infinite potential of its abstract fungibility, it can be anything, anywhere, and the finite determination of the actual moment of payment. It is both the principal source of our vulnerability in society, especially when its value is unstable, and at the same time the main practical symbol allowing us to make an impersonal, vast world meaningful and calculable. The sources argue that the ultimate human task is not to reject money and markets, but to humanize and re-embed them.
Finally, we have to acknowledge that even with society's resistance and its complex, embedded nature, the market system still inevitably fails or concentrates wealth, leaving individuals at the margins. What mechanism does society use to address those who are completely excluded from reciprocity or market success?
This is where welfare and large-scale redistribution step in. Welfare, broadly defined, whether as private charity, philanthropy, or state intervention, is concerned with the margins, the gaps, and the cracks in the social system, where individuals are excluded from traditional forms of reciprocity, communal sharing, or the market itself.
So it's a safety net.
It serves as a necessary, secondary, or auxiliary form of redistribution, acting to alleviate poverty and address market-driven impoverishment.
But is the welfare domain itself immune from the pressures of this calculative market logic?
Unfortunately, no. Even this domain of social assistance is increasingly vulnerable to colonization by calculative reason. We see this today as charitable organizations, community schemes, and nonprofits must simulate the values and practices of commercial firms just to secure funding. They're often forced to adopt market metrics, focus on measurable outcomes, or use mechanisms like vouchers or outsourcing services. This simulation forces welfare organizations to speak the language of the market, effectively blurring the essential line between genuine social assistance and a purely contractual market transaction, even within society's final line of defense against market failure. This shows how deep the financialization has become in the post-1971 world. What we have established across our sources is that the monetary system we inhabit today, relying on irredeemable paper since 1971, operates without the institutional limits provided by tangible anchors like gold. This removal of constraint fundamentally changes the structure of governance. This system inevitably creates the political space for the abuse of money creation, which directly fuels massive financial speculation, destroys public confidence in the currency, and imposes severe, measurable social costs. This was brutally demonstrated by the historical catastrophe of Weimar Germany, where the stable foundation of the planning-oriented family unit was fundamentally undermined by the hyperinflation. The lack of a defined, trustworthy unit of account makes long-term economic calculation impossible, favoring only short-term speculative ventures and chaos.
Despite this challenging reality, the human economy is also characterized by a powerful and persistent struggle to re-embed the market logic within social restraints. Whether we look at China's state-led structural discipline, which consciously restrains the market's reach to ensure stability, or the historical periods of hard money stability like the gold standard boom in the US, societies constantly seek dependable anchors.
They do.
The modern experiment of fiat currency is built entirely on the hope that political and bureaucratic managers have finally mastered a system that historical precedent suggests is inherently prone to collapse when that delicate, abstract token of trust is ultimately lost.
And capitalism, particularly through the lens of global financialization, remains a force instrumental in making world society more integrated. However, the sheer scale of the global financial system means that its stability rests on the absolute integrity of institutional frameworks and, critically, on the universal hope that the token of pure faith we call money continues to be accepted, even without a physical tether to reality. We must understand money not simply as a transactional economic tool, but as a critical social and political artifact that requires constant vigilance and institutional anchoring to prevent structural and institutional decay.
That reveals a tremendous tension at the core of our modern financial life. The perpetual struggle between the abstract efficiency of the market and the deeply embedded, tangible needs of human society. It compels us to consider how we can effectively impose limits on a system designed, for the first time in history, to operate without any hard limits at all.